Hello traders. How are you all? Welcome to our channel, Trade Like Assad. Today, in this video, I will be discussing a trading approach known as the Darvas Box theory, which is commonly used for trading stocks with strong momentum. The Darvas Box system was developed by Nicholas Darvas, who gained significant fame through his book, which was highly appreciated by traders. We will cover how and when the Darvas boxes are formed and the key parameters to monitor during this process. But before we dive into the video, if you find this topic helpful, make sure to hit the like button, and if this is your first time here, don't forget to subscribe and turn on the notification bell so you never miss our latest updates. I'll see you after the intro and disclaimer. It is quite simple to grasp the Darvas box trading system. This strategy is essentially a techno-fundamental approach, which means we take into account both technical analysis and fundamental analysis. On the fundamental side, we examine factors such as the P/E ratio, future plans, debt reduction, financial statements, and company profits. From these criteria, we can identify companies that are performing well. Once we have shortlisted them, our next task is to analyze each company's stock and identify better trading opportunities. When the price is trending, it continues to move by shifting from one range to another. As you can see here, the price is in a long-term uptrend, but initially, it moved within a short-term range. After some time, a point occurred where the price broke out of the current range, moved higher, and then shifted to another range above the previous one. Therefore, during this uptrend, we can observe these boxes progressing upward as the trend continues. Similarly, in a downtrend, the price moves within a range, then breaks the current range, moves lower, and enters the next range below the prior one. Here, we are discussing a swing trading strategy, so we will be analyzing our stock chart on the daily time frame. This strategy is quite straightforward and engaging. Our initial task is to locate stocks that are fundamentally strong according to our criteria. After that, we will observe each stock on the daily chart and attempt to draw the Darvas box. When the price breaks this box, we will take our trade entry. But the question is, how do we draw the Darvas box? Let me explain this in a simple manner. So here are the rules for plotting the Darvas box. First, the price must be in a proper uptrend. After that, we look for a price move that creates a new 52-week high. Once the new high is formed, there must be 3 consecutive sessions that do not cross this high. When these conditions are met, we can mark the upper boundary of the Darvas box, and this upper boundary is known as the ceiling of the box. Now just wait for the price to form its low. After this low is made, it should not break for the next 3 candles. This low forms the bottom of the box, and this lower boundary is called the floor of the box. With this, our Darvas box is ready. Now the price trades inside the box, and we wait for a candle that breaks above the upper boundary for our buy entry. But for a valid breakout, the breakout candle must have 2 specific characteristics. First, the breakout candle must close strongly. Therefore, the candle should have a tiny upper wick so the high and close remain very close to each other. Second, the breakout should come with strong volume. For this, we will use the 25-period volume moving average, and the breakout candle's volume must be above the 25 EMA. These rules increase the probability of a meaningful breakout. Let's check an example to see this clearly. As you can observe here, we have a stock chart on the daily time frame. Initially, the price is trending upward. At this point, the price made a high. After forming this high, look at the next 3 candles. These 3 candles did not break the previous high, so we draw the upper boundary of the Darvas box here. Next, this candle formed the low, and the following 3 candles did not breach this low. So here, we mark the lower boundary of the box, and our Darvas box is complete. Now wait for the candle that closes above the box. Here, this candle closes above the upper boundary. But does this breakout candle have enough volume? In this case, the volume is above the 25-period EMA. Also, this candle has a tiny wick near its close. This combination of strong close and high volume signals a reliable breakout. After fulfilling these rules, we will place a buy order at the high of this candle. If we follow the basic traditional method, our stop loss will be at the lower boundary of the box. But in many cases, that stop loss becomes very large, and to make the position successful, we would need a higher target, which is difficult in most situations. So instead, we should place the stop loss at 40 to 60% of the box height. If the box is tall, the stop loss should be closer to 40%, and if the box is tight, we can keep the stop loss near 60%. Always remember, my friends, stop loss placement requires advanced risk management understanding. In this example, the box height is not very large, so we will set the stop loss at 60% of the box height. For this trade, we will target a 1 to 2 risk-to-reward ratio. The risk-to-reward ratio can be adjusted depending on the market environment. Here, after our buy entry, the price continued moving higher in the uptrend, and we successfully hit our target. That's it, my dear traders. Thank you for watching this video. There's a version of you in the future that's stronger, smarter, and more confident, and they're waiting on the choices you make today. If this video pushed you closer to that version, hit the like button, and if you're new here, subscribe and tap the notification bell to stay committed to your growth. Progress isn't loud, it's intentional. Don't stop now, you're closer than you think. Stay consistent, stay hungry, and I'll see you in the next video.